Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
Well, good morning and welcome to Consider This. I'm Joe Clark. So happy to have you along. Hope you're having an outstanding week and things are going great for you. Got a lot to talk about on the show today. I do have some challenging information that I have to pass along to our flagship station. WQME 98.7 The Song has made a decision to change their format. So at the end of this year, apparently, after 10 years, my show will no longer be able to be heard on the station. We'll figure out what happens, and it's certainly not my choice. I love the people that are there. I love the market that's there. They're just going in a different direction. So I want to remind you, you can always find our program on our website at yourlifeafterwork.com. You can find it where it goes automatically to your cell phone device off of iTunes. We turn the radio show into a weekly podcast. Consider This with Big Joe Clark. We're going to spend more time doing that. And of course, there's a whole host of other stations that are out there now. They syndicated the show a couple months ago, so we're in 15 different states and in different places. But we have certainly enjoyed our time with 98.7 The Song. I think I'm probably, though, one of the longest standing people that have been involved in the station now, and so it's really kind of a sad change that's taking place. Being able to educate and communicate with people about what's going on about their money has been one of my driving forces. People call me a financial pastor. We care about you understanding about charitable gifting and about how money works. So it's always frustrating when changes are made that are beyond your control, but they do happen, and that's part of the deal. And from a financial planning standpoint, we talk about the 5 critical elements: your life after work, the tax plan, the investment playbook, life happens, and the estate planning. And life happens are those things that sometimes, good, bad, and ugly, you just can't necessarily control on your own. They're things that pop up that we just have to deal with. And like I said, some of them are great things. People getting married, having babies, buying their first home. Some of them are great. Some of them are not so great. And those are the ones that you really have to be prepared for. Of those 5 critical elements, all things can really throw you off your game or drive you in a different direction. And we've built our practice to a large degree around educating people about finances, about their money. We've done that on this show. And so it's going to be a big change for the Financial Enhancement Group, but it's not going to be a big change for you. Remember, you can go to iTunes, Consider This with Big Joe Clark, and of course on our website at yourlifeafterwork.com. We've got a great show for you. Sherry and I are ready to roll. Hope you're having an outstanding week getting ready for the wonderful Christmas season. We look forward to talking to you about a lot of things. But we'll take a break in the meantime. Be right back. Don't forget to email me, considerthis@yourlifeafterwork.com. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com. Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
So happy to have you along. Hope your day is outstanding. Hard for me to imagine that it is December already.
For sure.
The year is coming to an end. We're going to talk a lot today about the tax code, obviously, things that are going to have to be done very, very quickly. Last time we changed the tax code was 1986. It was the beginning of my career. Lots of things that are going on. But today we have a special segment from a friend of mine up in Chicago. So here's the deal. You all know about the 5 critical elements. We've talked about this many, many, many times. So you've got your life after work, which some people call retirement, the tax planning, the investment playbook, life happens. But the legacy plan is also out there. And some people call it estate planning. It's a documents. It's how you want things done. But I just want to give you good insight into how to think and to feel about how the legacy plan works. So we've got Jennifer Quigley with us today. She's an estate planning attorney, and I can't even pronounce your middle name, Jennifer. So you're going to have to do that. Is it Goodman?
Yeah, sure. It's Gimo.
There you go. See?
Wow, is that Italian?
It's a beautiful Italian name.
Wow.
Oh, French actually, but
French.
yes.
Well, I like Italian better, so we're going to go there. Anyhow, we're welcome to the show. This is your first time. We don't, those of you who listen to the show a lot know that I don't let many people come on the show. That is not the intent. But Jennifer impressed me, and I think she's going to impress you as well. So we're going to talk a little bit today in a couple different segments of the show. One is going to be about the pitfalls of do-it-yourself estate planning. I don't see a lot of that anymore, but it still happens. And
the do-it-yourself stuff?
The do-it-yourself stuff, but it is still very dangerous, Jennifer.
Yeah.
So why don't you go ahead and give us a rundown of what you see in your practice?
Sure. And I will say in my practice, I feel like in the last few years there has been an increase in clients coming into my office with their do-it-yourself estate plan in hand and wanting me to review it for them to let them know if there are any issues. And in each and every of those cases, I've found issues with those plans.
Yeah.
But, if we're talking about just some sort of high-level issues that I've seen with the plans themselves, I think one major downfall is the lack of flexibility that these plans have. Each client's needs are very unique. And these software programs that they're using to do their plans are really limited by the programmer. So they have, their unique set of circumstances, but there is just, a given set of questions and answers for them to give. And so they don't have anyone looking at their estate plan in a global sense and giving them, some global advice. They have just, they're very limited by the questions that they are posed by these programs.
Right, the box.
And the answers that they give.
Yeah, the box. So first and foremost, right. Jennifer and I would both tell you, we are not trying to give you estate planning advice on the show. This is not, it's not an idea of taking what we talk about here and going and putting it into work. What we try to do, just like I do with the rest of the show, is try to give you ideas and things that you need to consider and make you aware of challenges that are there. And one of the things that I try to point out to the families that I see, Jennifer, when they come in to see me, everybody wants to talk about an estate plan in terms of where the money goes when they're dead. I try to remind people that 10% of us die, 90% of us fade away, right? And so the document really needs to take care of us, not just our kids, not just our spouses. Right. It needs to take care of us as well. So when I look at the do-it-yourself stuff, it really becomes problematic from that side. But what are some things that people should be looking at in their plans to be aware that they have a weakness?
Well, I think again, I think it's difficult for someone to identify within their own plan what could be wrong, because that's why attorneys go to law school. We learn what the law is. We learn how to appropriately execute these documents with all the right language, with all the right bells and whistles, executing it with all the requisite formalities. So for someone to look at their own plan and try to identify any red flags, it is asking a lot. Yeah. So I would say, if you have a do-it-yourself plan and you've put it together and you're not sure if it's good or not, seek out local counsel. Someone in the state in which you reside should be an attorney who's licensed and who practices in the area of estate planning, should take a look at it and review that for you and let you know if there are any issues with it. And if there are, then, perhaps getting it redone with the attorney might be a really good first step.
Yeah, it's I used to tell people at Purdue when I taught that, it's a double curse of knowledge. I don't know what I don't know, but I also don't know what the other person on the other side of the table doesn't know either. And when you're doing your own estate planning, it's very, very difficult to know what you don't know.
So Jennifer, I have a question. Do you find that the laws that go around estate planning change often? That people would not even know about those on their own?
That's a really great question. So there are both state and federal laws that affect estate planning, and from state to state, laws can definitely change, and certainly at the federal level as well. When those changes come, we just it's hard to predict. I wouldn't say necessarily that it happens really frequently, but it happens enough that having an estate planning attorney, at least in your Rolodex, to reach out to say, hey, I heard this on the news. Is this going to affect my plan?
Right.
A lot of practitioners I know actually send out sort of communications on an annual basis, asking their clients to come in and talk to them if any number of things have changed for that client, or to advise them of a new law and to let them know to come in and change their plan. So to not have that resource at available as a client because you use the software program, that's a major disadvantage.
Right.
Yeah. We're talking to Jennifer Quigley up out of Chicago. She's an estate planning attorney. Jennifer, if somebody wants to get a hold of you, what's the best way to do that?
Yeah, they can either call into the office at our main line, which is 312-754-1319, or they can certainly send me an email, and that email address is Jennifer, JENNIFER, @gqlawoffice.com.
Yeah, and she actually responds to her email. It's
old school.
Anybody who knows me knows that we have a 24-hour communication rule with the families that we take care of. And if you've listened to the show for the last 3, 4, 10, 20 years, I think Jennifer's the 5th person I've let be on the show. And it's, I like people who actually respond to their emails. And Jennifer, you said something that I would argue with a little bit, that the rules don't change a lot. So we're here in Indiana, and I will tell you that in Indiana, over the last 3 years, we've eliminated the inheritance tax. That is a major issue. The second thing that we did was allowed trust protectors to be put into the trust, so that we are able to decant. We're able to fire corporate trustees that are misbehaving, which we all know occurs. And the third thing, and it's a big issue, you can, from a standpoint of a TOD or POD, transfer on death or payable on death, or beneficiary designation is the best way to look at it. We can actually put our homes in a cycle so that we can keep them out of probate, even if we don't use a trust. So there have been 3 major changes that I think impact a lot of people here.
Okay, yeah. So it is very state specific, and having that local counsel in the state in which you reside is so important to know what those changes are on an ongoing basis. Absolutely.
We're going to take a break. We're going to come back, and we're going to talk about special needs trust. That's one of the reasons I have Jennifer on here today. If you got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. We will take a break and be back in a flash.
Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money attorney in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
And we have Jennifer Quigley along with us. She's an estate planning attorney up out of the Windy City.
Yeah. I wonder how windy it is today, though. It's nice weather in the
It's
middle.
windy in Chicago.
Well,
it's the politicians breathing. Right, come on. This has nothing to do with airflow coming off Lake Michigan.
I see.
It is. Anyhow, Jennifer, I appreciate you being on the show today. We do our best here to try to teach people to better understand their money and their needs. One of the challenges, and I don't know, maybe we're just more aware of it, I don't know, but one of the things that we see is a lot more special needs issues that are arising, whether it be autism or other issues that are coming out of kids. So why don't you tell us what a special needs trust is and what we should be considering?
Sure. So a special needs trust can be pretty much summed up as a special type of trust that's established either by a third party or by a disabled individual with a disabled individual's own funds. And what this trust does is it enables the beneficiary to receive government benefits, such as Medicaid, and still have their supplemental needs met from the assets of the trust. And so when applying for something like Medicaid, applicants need to disclose all of their assets. And so, if their assets reach a certain threshold, they won't qualify. However, having money in a special needs trust will not disqualify them from qualifying for those Medicaid or other government benefits based on their disability. And these types of trusts can also be referred to as supplemental needs trusts.
So why is it that it keeps them from still getting the benefit?
Well, so what the special needs trust does is it will house assets either funded by that disabled individual or by a third party, maybe a family member on their behalf. And what happens is the trustee is someone that is not the disabled party. So it's someone else. It's an outside third party. And that person administers this trust in such a way as to not provide for the needs that are already being provided for by these government benefits. So an example of some supplemental needs that a trust such as this could cover would be things like equipment that's not covered by current benefits being received, travel, classes, enrichment activities and hobbies, and other entertainment type items. This is just a list of some things that could be covered by a special needs trust.
So by design, it's anything that you don't have to have, right?
Correct.
That's pretty much the best way to think about them if you're going to do a special needs trust. You cannot provide anything that they have to have. It's the extras in life.
I see.
That's right. Because, the key here is not to disqualify that beneficiary from their government benefits. And if payouts are paying for things such as needs that are already being covered by a government benefit, then that could disqualify that beneficiary. So it's a very technical type of trusteeship, and a lot of times these trustees are corporate trustees, entities and companies, corporations that do this routinely, and they know the rules and they know how to make sure that disabled individual does not get disqualified from their benefits.
So I have never heard of this kind of trust before. Is this like a new thing, or a lot of people taking advantage of it? I mean, it's not
advantage of it.
I don't mean in a bad way.
No, it's not new. I think what's happening, Sherry, is there are just more and more people who have a need.
Yeah. Well, yeah.
I made it 40 years before I heard the word autism, I think.
Mm-hmm.
And now we have 2 or 3 kids in our family that have autistic, 10 trends
on the spectrum.
Yeah. So I think it's a serious issue. But the bottom line is when people do their trust, Jennifer, when you and I are both trust proponents. I've yet to find anybody other than an attorney who makes money off probate convinced me that a trust is not a good idea.
Right.
When I don't have anybody in my family that is receiving a benefit from me when God calls me home that is autistic or has a quote unquote special need. I still have a clause in my trust that says, should one of my beneficiaries qualify for...
Do you really?
Absolutely, I
Wow.
do. Why wouldn't I?
Well, no, why
Right?
wouldn't you? I'm just saying,
And,
I had not heard of it before.
And so it's something that needs to be there. And again, Jennifer, our last segment was talking about do-it-yourself investment planning or estate planning and the problems, the pitfalls. That's one of them. I don't think most people consider that.
What's the qualification to? I mean, how do you qualify that as that someone needs to be designated as a special needs?
Go ahead, Jennifer. You take that.
I think that is such a great point, and it's really it goes back to what we were talking about earlier about having an attorney assisting with estate planning instead of a do-it-yourself software package. Asking the question, does anyone in the family have special needs that might be a beneficiary of this trust, or is there potential, or even if there's no potential, you put the clause in, and so you can have sort of that springing clause if there is a beneficiary who doesn't have any special needs or issues now, but down the road it's discovered or it happens. And in that event, if they were to receive an outright inheritance, that would disqualify them from receiving government benefits potentially. So having that clause in your trust is so smart. It could remain dormant and never be in effect at any time, or it could spring into being in effect if there is a beneficiary who later on down the road does have a special need. And I do know that that's a widely accepted practice for estate planning attorneys to go ahead and plan for that and put those clauses in trust planning. And I wholeheartedly agree with that.
You must be smarter in Chicago, Jennifer, because I'm the only one other than attorneys that I have told to put that into trust. I have never seen that in a trust.
Oh, wow.
I have 7.
I thought it was customary.
No, I have 7 things in my trust that will hopefully remain dormant. And the advantage, and you'll get a kick out of this. I was one of my families was told that I was a TV personality and really didn't know anything about estate planning last week.
Whoa!
By an attorney who wanted to charge $30,000. So get a load of this. They had they had an annuity which has a beneficiary designation. They had a joint bank account. They $2.2 million, and they had a $300,000 home. That was the only thing that was going to go through probate, and they wanted to charge $30,000 to be able to probate the estate. And I'm a TV personality. What do I know?
Wow.
Anyhow, I was majorly offended. If I could do if I could transfer the home on my own as a non-attorney, I would do it for free just to stick a needle in their eye. But that's me. So anyhow, Jennifer, what should people be? How do you pick an estate planning attorney? I mean, I know what I would be looking for, but again, I've done this for 30 years. How do I find you? What would I do?
Yeah, I mean, I think first things first. Where do you live? If look within the jurisdiction in which you live, because estate plans and the laws about drafting and executing documents vary by state. So you're going to want to look for someone local in the state in which you reside, and someone who does estate planning as a large portion of their practice. I certainly think it's better to have someone who focuses on it, as opposed to someone who does many other different areas of law, because there are enough things that change and there are enough things that need to be kept up with as an estate planning attorney, that it's important that it's a major focus of that practitioner's practice.
I would agree.
And it comes down to personality. Pick someone who you gel with and who has good communication style. Right. I think that's a large part of it as well.
We got to take a break, Jennifer. We're going to come back and we're going to do one more of these. If you got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. For the last 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share that with you, what we use to protect more than 700 families, more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry before the crash in 1987, and I've been an active participant helping families like yours strive to build a secure retirement.
Here's what I've learned as a certified financial planner, a former professor at Purdue University, and as a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the Internal Revenue Service. You can reach us at 800-928-4001 at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group Incorporated, member FINRA and SIPC. Again, that number is 800-928-4001, and you can reach us at yourlifeafterwork.com.
Well, good morning and welcome back to Consider This. And Jennifer, I know you've got to, we're talking to Jennifer Quigley, by the way, an estate planning attorney out of Chicago that I am impressed with and enjoy the conversation. And Jennifer, I know you have court, so when you have to go, you just let me know. But I want you to, I really do it. You know, I when I taught at Purdue, my students would ask, how do you find a new client? And at the Financial Enhancement Group, we don't call them clients. We refer to them as family. And I say, you know, it used to take 4 things. First, you find somebody that you like and trust. And because of Madoff, because of Shrinker jumping out of a perfectly good airplane in Florida, the other 3 no longer matter. But the other 3 really are in my business. The first one is, do you like and trust them? They've got to relate to you. The second one is, do you think they know what they're talking about? The third is, do you understand their process? And the fourth is, do you need their process? So here I am, and you know, the estate planning is one of those things, sadly enough, that I think people do once in their life, right? It's one of those things that they think they can be done and check off. If you knew the number of wills or trusts that I've seen that were written in the 1990s, it would probably shock you.
That are still in effect, that are still
they're still out there.
They're still out there.
You know, but I mean, so many rules have changed. But Jennifer, so I grab a phone book and I decide that I want to get some estate planning done. How do I find you? What questions should I be asking? And I think you hit a big one when you said somebody who spends the majority of their time inside of the estate planning part of their practice.
Yep.
If somebody, and this is an unpaid endorsement of you, but if somebody does a divorce at 10, a lawsuit at noon, a DUI at 3, and tries to write your trust at 4, you got the wrong person.
Yeah.
Right.
So, I mean,
right. You know, there are many ways that, you know, clients can start the process of looking for and interviewing estate planning attorneys. And I say interview and I say plural attorneys because I think it's important to talk to at least a couple different attorneys. You know, there can be major differences in recommendations, in pricing, in personality, in how they operate in the process. So it's good to get a couple of attorneys, interview with them and see how they work. But, you know, I think one really crucial step, Joe, is that, you know, if the client already has a trusted advisor, whether it be a financial advisor, an accountant, someone they work with, that would be a good first step. You know, ask them, you know, do you have anyone that you've worked with? Can you let us know if there's anyone that you would recommend? I think that's a really, really good first start because going out into the world of the internet and just doing, you know, blanket searches, you just don't know exactly who you're getting that way. And I think, you know, it can be a real help to reach out to a trusted advisor who you've already worked with and already have a trusted relationship with, and maybe ask if they've got anyone that they know or can recommend. You know, the other thing is to ask family members who've had their planning done, who are happy with the services, close friends. You know, I think that's always a really good start before just doing, you know, a general search on the internet.
Okay, that's fair enough. But so Jennifer, I started when I was 21 in this industry, and my only way to really grow was to know more than anybody else in the room. I spent a lot of time figuring out how to get smart, and I didn't, you know, not many people came to me because at Rotary and everywhere else, they knew the attorney next to him, right? They felt comfortable with this person or that person because they'd been in the community for 20 years, not because they were necessarily competent, right? So if you're going to go that route, here's what I would say, and here's what I do when a new attorney comes to me and says, "Joe, I want to work with your families." I want 10 families where somebody has died. I don't want to know about your document. I want to know what happened
Mm-hmm.
after they were gone. Because
Mm-hmm.
what happens is the majority of time, in my opinion, what I have seen is that people find people that they know at church or that they know from the country club or they know from Rotary or some other civic organization, and they seem to be good people. But the problem is competency is not limited to good people.
That's right.
You
Yeah.
know, there was a doc in town that when my mom needed surgery, you know, one of my other docs said, if he can't do it, get her out of town. You know, and he was a jerk.
Yeah.
But
Yeah.
he knew what he did. He knew what he was doing with a scalpel in his hand. And so
Right.
you really, I don't think this can be just personality based. You obviously want to deal with somebody that
For
you
sure.
like and trust. But
And, you know,
competency is key.
mhm. And you know, you're right. I mean, it's not always easy to identify whether that attorney is really good at what they do, or maybe they've just been doing it forever and everyone uses that attorney, and so that's why that they're recommended. But I think you hit it on the head. Do they also, just to add to it, do they also administer the estates that they draft? So I know some attorneys just do the drafting piece, and then when it needs to be probated, or hopefully not probated because trust planning is avoiding the whole probate process, right?
Yep.
But the administration of the trust and or the estate, who's doing that? Is it a totally other firm? So they never see the back end of their drafting. They never get to see whether it works or not. Or are they the ones that are administering these plans? And I think if you have an attorney who's doing everything for that family and sees how their drafting is working on the back end, that's an amazing testament to whether or not their plans work, right? You know, it's not tested until, unfortunately, the client becomes disabled or dies. So you're right. You're absolutely right that seeing it on the back end is so important.
It's just, and you would be, I mean, you wouldn't be, Jennifer. I'm sure you've seen it, but the majority of us that I see that have estate plans. So when somebody comes to me to do legacy planning work, it's generally because something happened to somebody else near and dear to them. They lost a parent, they lost a sibling.
Something triggers it like that.
There's a triggering event.
Yep.
And the majority of people who come to see me have never gone through the process of what, Jennifer, you just called administering or administering. It doesn't. I see a lot of documents. And, you know, it's the strength of being, you know, we take care of 800 families plus in 31 states. I've read a lot of trusts from a lot of different attorneys. And you know, I can't practice law. I can't tell you what's wrong with it. I'm not supposed to tell you what's wrong with it. I will just tell you that there are in many cases things that are missing, in my opinion. So, Jennifer, give us, we're about out of time. Go ahead and give us the way to get a hold of you again so we can have another great conversation.
Yeah, that'd be great. Yeah, so I can be reached either at my main line here at the Chicago office, 312-754-1319, or email, which is Jennifer, that's JENNIFER, at GQ Law Office. And I will just say, you know, all of what we've been discussing is just, you know, general and should be, you know, just used as general guidance instead of, you know, legal advice. And any listeners who have specific needs for legal advice should consult with an attorney of their own.
Absolutely. And an attorney in your own state. I mean, there's no, we try to use this show to bring up things that you need to consider. Not, you know, it's just as simple as I know how to put it. This is not specific. Do not self-medicate. It is a dangerous world out there. We just want to bring to your attention things that you need to be aware of. So, hey, you're listening to Consider This. I'm Joe Clark along with Sherry Contos. Jennifer, we greatly appreciate you taking time to be on the show. Hope everything in court goes well for you this morning.
Thank you.
You got a question or comment, shoot us an email, considerthis@yourlifeafterwork.com. We'll take a break and be right back.
Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money money in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
Well, good morning and welcome to Consider This. I'm Joe Clark. So happy to have you along. Sherry had to step out on this particular segment, but a lot we needed to talk about anyhow to come in with the year-end planning. And I really dislike talking about things before they occur, but Congress and Senate have both passed or at least begin to sign off on their legislation. They're in reconciliation, if you will, and then the White House has to sign off. But it sure looks like it's coming. And if you've paid attention to this show, you know we are very focused on some of the tax planning things that will change. So just 3 things to keep in mind quickly, and then I'm going to get you to one last point that you may want to consider going into year end. Remember, when I say year end, it's not April 15th. It is December 31st. It's where you have to be ready to go by the very, very end of the year. And if you're new to the show and it sounds like a weird radio show, I'm a certified financial planner. I manage over $300 million for families in 31 states. We're registered investment advisors, and but the other part of it is I spent 7 years as a professor at Purdue teaching financial planning. And so if it comes across a little bit different than what you're used to hearing, I guess that's great because that's what I'm trying to get accomplished. But I want you to be able to learn and consider things with your money. We're here and more than happy to help. You can find us at 800-928-4001. But the point of the show really is to help people better understand their money. So let's hit the 3 things that concern me the most. One, there is a process called the Roth recharacterization that we have used for the last 7 years inside of our firm. And what a Roth recharacterization allowed you to do was take money out of an IRA, put it into a Roth IRA, wait essentially until October of the following year to decide whether you want to keep it or not. And if you didn't, you could truly recharacterize, do what we would call in Indiana a do-over. So we do that every year with multiple Roth IRAs for our families. The legislation we knew was going to stop recharacterization for 2018. We did not suspect that it was going to stop ones that occurred in 2017 to end year end. So in our case, we have many families with multiple Roth IRAs that we have to reach out to and say, hey, we no longer have until September, October of next year. We've got to make a decision here toward the end of December, and that has got to occur very, very quickly. So please make sure if you engaged in that conversation that you understand the Roth recharacterization is most likely reached its end point from the December 31st of this year going forward. Secondly, when we talk about itemized deductions, your CPA will tell you if you're married filing jointly that you get about $12,700 of a free amount you can deduct. That's the standard deduction that every married filing joint family gets. It's about $6,500 if you happen to be an individual. Well, that deduction is now going up to $24,000. It appears, again, nothing signed off as the time of the taping of the show, but it appears that it's going to go to $24,000. That being the case, you may want to look at this and say, hey, maybe I want to pull forward some deductions into 2017 that I would normally invest in 2018. For instance, we find the big 3 are state and local taxes. Many times those aren't paid until April. I will probably be paying mine in December. The second thing and then is mortgage interest. Very hard to accelerate that, but charitable gifting is a big deal. And when I look at most of the families that we take care of, it is very common to see itemized deductions of $18,000 to $20,000 a year, meaning that next year they wouldn't get any credit at all for their charitable gifting. So if we can accelerate that into this year where they actually make those charitable gifts this year, then they could take the standard deduction next year. Everybody wins except for the IRS, and we like that. That is our job. Then last but not least is looking at your qualified charitable distributions, especially with itemized deductions as high as or standard deduction as high as it appears that it's going to be. If you are over 70 and a half, in other words, if you have to take required minimum distributions from IRAs. You now have a permanent part of the tax code that lets you take money directly from your IRA and send it to 501c3 entities of your choice, whether it be your church, universities, hospitals. As long as they're truly a 501c3, it goes to the general fund, and you receive no direct benefit for it. You're able to make that gift. You have to pay no taxes on the RMD, which could make your Social Security less taxable, reduce your Medicare Part B premiums. All sorts of good things can happen from this, and you can do it up to $100,000 a year, depending on where you are in life and what strategy that you are trying to employ. Now, why would I want to do this? Well, because next year, let's say you're that my average family, $18,000 to $20,000 of standard or of itemized deductions. If the true deduction next year is $24,000 for a married filing jointly, you're not going to get any benefit for it at all. There's no reason to recognize that income on page 1 of your tax return, and you may very well want to accelerate or pull forward those charitable deductions. Now, the other thing that you want to do this time of year, and this is very, very important. If you've heard the show for a long time, you know I talk about 3 tax returns. I pay attention to mine, obviously. I try to pay attention to my mother's, and I try to pay attention to my kids that are adults over 25 years old or married. And the reason I do that is that typically we're at 3 different tax bracket levels, but I want to make sure money is being used correctly. When you look at our tax system, think about a stair-stepped system. So line 43 of your 1040 tells you what amount of money you're going to pay taxes on. That's after your exemptions and your itemized or standard deductions. And then there's a block of money that you're going to pay 10% tax on. Depending if you're married filing jointly or not, you're going to take a 50% jump. Nobody ever pays attention to it. Good Lord, it's 50%. You'll take a 50% jump up to the 15% bracket, then the 25, etc. That's going to change a little bit next year, but the top's all the way to 39.6%. And there's nothing that hurts my little heart more than when somebody comes to me, they're 62 to 66 years old, they've got $1 million in an IRA, and I look at their 1040 and they're in the 10% bracket, and then they tell me about their 3 kids that are very, very successful that are all at higher brackets. Folks, we want to do everything that we can to to bump that bracket. So, for instance, in 2017, the 15% bracket, married filing jointly, right? 15, and then it goes to 25. Everything up to about $76,000 is taxed at 15%. Remember, capital gains and qualified dividends, long-term capital gains, I should say, aren't taxable at all if you're in that bracket. But everything up to that top of that bracket is 15%. If you've got your beneficiaries that are going to be out there that are inheriting money, or if you've got a large percentage of your assets that are in IRAs and 401ks, and you know when one of the spouses passes away, you or your husband or your wife, that you're going to be forced into a larger marginal bracket. It is time to take action now, my friends. Let's sit down, have a cup of coffee, and talk about this. You can give us a call at 800-928-4001. And as I say every week, I don't give you enough on this show. I don't have enough time to look at your personal situation and say this is exactly what you ought to do. I just want to give you things that you ought to consider. So if you're working with another certified financial planner, another fiduciary, if you actually engage in tax planning, which I'll tell you most people don't. I work with a bunch of CPA firms, Huth Thompson on the west side of the state, Step and Doctor in Delaware and Madison County, Brett Spangler and Mike Laird down in Indianapolis. We all work together to try to make sure that people are in the right situation at the right place, that you've got to have everybody on the same page as you engage in this tax planning. I will just tell you, as a fiduciary, as somebody who tries to do everything to eke out every single inch of return that we can get in a portfolio without adding risk, sometimes the best gains that you can get with the least amount of risk you're going to take are truly on your 1040, and that's what we strive to do. Hey, you got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. Don't forget there's lots of ways to find our show. You can also find us on our website at yourlifeafterwork.com or iTunes. Consider this with Big Joe Clark. We got to take a break. We'll be right back.
Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com.
Good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along.
We are.
It is the Sherry segment.
My favorite.
I have no idea what she's going to... She was talking about Google and Hummingbird and all these other...
Yeah.
All right. So,
Well, yeah. So I do Google a lot of things for this show, Joe. Lots of prep. I really work at this hard. So I get fed stories because of the algorithms that are in Google. And this one caught my attention for 2 reasons. I do have people ask me about getting in contact with you and having advice, and they're for whatever reason reticent to do that. They're afraid they're not going to have their stuff together. One of the questions they ask me is, how much money do I need to have to actually seek professional advice to have my money taken care of? So that's, put that to the side. How much do I have to seek professional advice? But the other question is, how much do I really have to retire? And this is what I know that's not an answer that you can just come up with a dollar figure for, but I came across an article that said $1 million retirement nest egg isn't enough anymore. And I want to just probe that a little bit because people get stuck on numbers, and I know that's your pet peeve. They look at the bottom of the statement, they see what that number says. But in thinking through when do I get professional advice, the other question is, when do I have enough? When am I okay? When can I start relaxing about the whole retirement thing? So first, to the point of having professional advice, but what I really want to talk about is, when do I have enough? Do you have a minimum in your head that people, when they can do it on their own and when they actually need to have someone help them?
I will tell you that we do not have a minimum, because my mother would spank me if I treated people differently over money.
Yep.
My 10 largest families have lots of zeros, and they know that by paying me, that it provides us the ability to be able to take care of people who wouldn't normally be able to see
someone like you.
Yep. So if you have more than $50,000 and you own a mutual fund, in my opinion, somebody has led you astray. Could have been yourself. Could have been the herd mentality world that we live in because everybody else does it. Mm-hmm. That it's okay. Your 401k has got mutual funds. I have 24 people on my team, and our 401k is exchange traded funds, and we manage $300+ million for people. There's a reason it's in ETFs. It's my money. It's their money. It's, if you own more than 50 grand and it's not, and it's in mutual funds, somebody has sold you a bill of goods that you should run from. So there's not necessarily a minimum. What I think you have to do is to understand the phase of finance that you are in. And, I made the mistake of telling one of my pilots, he flies the big 777 Dreamliner thing. He's
airplane.
I made the mistake of telling him that nothing changed from the time I got on the plane to the time I landed. And he went through a 2-hour, literally it was an hour and 50-minute dissertation over the different things that he had to do at different levels, at different periods, and the things that he had to be prepared for that could occur along the way. And what I have found is most people look at their statements, regardless of their age, in the same way, and that is an absolute mistake. The bottom line is you start off in an accumulation mode where your objectives are saving the right percentage of your income. And then number 2 is building tax diversification, which means you have some money that's tax-free. We're 20 years out from the Roth being created. You can't say that you didn't know now. It's 20 years later, right?
Yep.
You need some tax-free money, you need some tax-deferred money, and you need some money that's after tax. Eventually, you're going to get through a period of time that I call preservation. Consolidation is perhaps another good word, where your money you're still adding, but it doesn't matter as much as what you've already saved. And that's the only time that average return really matters. Mm-hmm. And then eventually you go to distribution, right, and that's where you start pulling the money out. So when do you know that you have enough? And I think that the key to that, and that's where you have to understand, yes, I'm a certified financial planner. Yes, I'm an assistant professor from Purdue University, but I've done this for 30 years.
Mm-hmm.
And there are periods of times where all three of the professional, the academic, and the life experience come into play and work together, and there's times where they don't. And when I hear somebody say, I need 70% of my income in order to be able to retire, gray hairs grow, heart rates go up. I just get livid. Academically, maybe, I'm not even sure that's right. But I will tell you from experience, my job is to replace 100% of your standard of living.
Right.
So if you make $200,000 a year and you spend $3,000 a month, I've got to replace $3,000 a month. I've got to be prepared to replace that as inflation increases. I've got to be able to prepare for that and replace that based on the taxation that it's going to come from. I don't have to worry about 70% or 140 grand to $200,000. What an arbitrary nonsense that is.
Does it not also depend on where you live and what? Because
but part of that would depend on how much money you need for your standard of living.
Right. Exactly.
In Anderson, Indiana, it doesn't take a lot to live.
No.
Right.
No.
We live here. That's the choice. You don't need $100,000 a year to have a great retirement in East Central Indiana. It's not required. In New York City, I'd probably be a pauper.
Yeah, right.
I mean, I'd be on a park bench.
But that's the reason in this article, if it was CNBC, you can't look at a number at the bottom of the list, your report, and say, okay, now there's enough. Now there's enough in the bank to last me. You don't know a lot of things you don't know about.
There are a lot of when a family's in here, I call it the Bad News Bears. And I don't know if you remember when the Bad News Bears coach wrote up the word assumption.
Oh, yes.
And then he drew he said, this can make this out of me and out of you.
Right.
And that's my problem with some of the extrapolations that we have of numbers that go up there of assumptions. You change one variable and you have a huge difference in result. And so you have to pay attention to the inputs: inflation, tax rate, assumed investment rate return, assumed percentage amount of savings. But the big thing I will tell you about what I call quote unquote retirement, which most people don't ever do. They do something different. They change their occupation, but it's not something, it's just different. What I will tell you is when you look at that and understand what's happening is you have a different type of expenditure. You have a social expenditure and you have a fixed expenditure. Mm-hmm. When you're 95, and folks, many of you listening to the show today will be 95 at some point in time.
That's true.
And you're going to need to eat. You're going to need to pay for shelter. You're going to need to pay for property taxes that they're not going to go away.
No.
But your desire to go see the Grand Canyon is going to diminish the older that you get.
Mm-hmm.
And one of the mistakes that I made from the CFP world, from the academic world, and helping people save and accumulate money when they retired at 62 or 65 is I've now got a lot of 90-year-olds with a lot of money and not a lot of life. And so we do things different here. We think about retirement. We don't just act based on Social Security models and based on other things that are going on.
Yeah.
Hey, I got to take a break. You're listening to Consider This. I'm Joe Clark, along with Sherry Contos. Shoot us an email. Consider this at yourlifeafterwork.com.
Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
Well, good morning and welcome back to Consider This. I'm Joe Clark. I hope you've had an outstanding outstanding hour. Sherry and I like to call it the fastest hour in radio. It does seem to go pretty quickly in our world. And we have a lot of fun in here in the studio. A lot of things that we talk about that make the show better. But the best thing that makes the show so great is the interaction that we get with you folks. And we certainly appreciate the questions, the comments, the emails. Consider this at yourlifeafterwork.com. You can always find us there. And, of course, our website, yourlifeafterwork.com. As I said in the very beginning of the show, and it's a frustrating topic for me, we've been with WQME for 98.7 The Song now for more than 10 years. And they've decided that they're making a change at the end of the year. And that the show will no longer be able to air as they figure out what direction they're going into the future. So hopefully we'll be able to negotiate with powers to be to get it brought back. I know it's a great time for many of you folks, time-wise, when the show airs. We're going to work to try to find it in other places. iTunes obviously works perfect because you can listen to it anytime you want to be there. Again, that's Consider This with Big Joe Clark. You'll find it. There's 3 or 4 other shows, I think, that are Consider This. So you have to put the Big Joe Clark part in to get that. But we're more than happy to have you along. I hope you guys understand why I'm spending so much time on the tax code. The first part of January, Wish TV will have me on Channel 8 down in Indianapolis, and they'll say, Joe, what should our goal and objective be for 2017 or 2018? Good Lord, hard to say. And I'm going to tell you right then and right there, the best part, the most important thing that most of us can do is get to know our 1040. You're going to go through 3 phases of finance, in my opinion, 3 different distinct areas where you have different goals and objectives. In that accumulation mode, when you're putting money into the accounts, your 2 primary goals are saving the right percentage of your income and building tax diversification. The tax return matters. Eventually, you get to a point in time that we either call preservation or consolidation. Both work, but it's a period of time where you may be still saving money, maybe you're not, but the amount that you're putting in is nowhere near as important as the baby that you've already built, the nest egg, if you will. And during that period of time, average return is what matters. Obviously being tax efficient as well, but that's when average return matters. And eventually, at some point in time, either on your own, you're going to start taking money out to supplement your retirement, or the IRS is going to force you out of tax-deferred accounts. And that's when you go into distribution, when you start taking the money out. And again, the 2 biggest goals during distribution are managing the volatility, the ups and downs of the value of the account between distribution, and secondly, it's the tax rate you pay on the average dollar you pull out. So in each one of those 3 areas, the 1040 had a different job to do, but a different, important, critical component of the whole decision. Just to bypass it, just to go through December 31st and be all jolly and happy, and then get all the stuff out in March and give it to your CPA and then cry and then repeat and do it again next year, it just doesn't work for me. Hope it doesn't work for you either. Hey folks, we appreciate you tuning in. Don't forget to call us, 800-928-4001. We'll say goodbye for the week. Have a great week. We'll see you again soon. Take care. Bye now.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a